Sunday alert, Sunday special. The truth about gold. 226, market. You wake up, grab your phone, and before you even get out of bed, you notice something different. Headlines are shifting, analysts are divided, and quietly, almost in the background, gold is starting to move again, not in a loud, dramatic way, but in that slow, steady rhythm that usually means something bigger is building underneath. And here's the part most people miss. The real opportunities in markets don't show up when everyone is already talking. They appear in these early moments of confusion and silence. And that's exactly where we are right now, standing at a point where gold could either remain underestimated or surprise an entire generation of investors who stopped paying attention too soon. Before we go any further, if you want to stay ahead of moves like this and actually understand what's happening behind the headlines, make sure you subscribe right now and stay connected with Metal Market Insight. Because what we're breaking down here isn't surface level news, it's the deeper story that most people overlook. And trust me, this one is worth your attention because the signals we're seeing in 2026 are not random. They're part of a much bigger shift that's been building quietly over the last few years. What makes this moment different is not just the price of gold, it's who is buying it and why. Because while the average person in the United States might still be focused on stocks, tech, or trying to keep up with inflation, central banks and large institutions have been steadily increasing their gold reserves. And they're not doing it for short-term gains. They're doing it as a strategic move, a form of protection against uncertainty that they clearly see coming. And when powerful players start acting this way without making noise about it, it usually means they are preparing for something most people haven't fully understood yet. At the same time, the economic environment in the US is becoming more complex. Interest rates have been pushed higher to control inflation, but that creates pressure on borrowing, spending, and overall growth. And while some parts of the market seem stable on the surface, there's an underlying tension that hasn't gone away. It has just shifted shape. And in situations like this, gold tends to re-enter the conversation not as a trending asset, but as a stabilizer, something that doesn't rely on corporate performance or policy promises in the same way other investments do. And here's where the story starts to pull you in deeper, because gold doesn't move based on hype alone. It reacts to trust. And trust in financial systems is something that can change faster than people expect. One moment, everything feels normal, and the next, small cracks begin to appear, whether it's concerns about debt, currency strength, or global tensions. And when those cracks start to grow, gold becomes more than just a metal. It becomes a signal, a reflection of how confident or uncertain the world really is beneath the surface. Now imagine you're sitting in the US in 2026, watching everything unfold in real time. Your expenses have gone up. The cost of living feels heavier than it did just a couple of years ago. And even though the markets are still moving, there's this constant sense that things are not as stable as they appear. And this is exactly the kind of environment where gold begins to quietly attract attention again. Not from hype-driven traders, but from people who are thinking long-term. People who are less concerned about quick profits and more focused on protecting what they've already built. What's interesting is that gold doesn't need a dramatic event to start gaining momentum. It just needs uncertainty to linger long enough. And right now, uncertainty is everywhere. From government debt discussions to global trade tensions, and even though none of these issues may seem urgent on their own, together they create a kind of pressure that builds over time, and gold responds to that pressure in a very specific way. It moves gradually, almost patiently, as if it's waiting for the rest of the world to catch up to what's already happening beneath the surface. There's also a pattern that experienced investors pay close attention to, and it's something most people overlook. When gold starts gaining strength while the broader market still looks relatively stable, it often signals that smart money is repositioning early, not reacting, but preparing. And this preparation phase is usually quiet. There are no major headlines, no sudden spikes that grab everyone's attention, just a steady accumulation that only becomes obvious when you look back at the data later. At this point, I want you to pause for a second and think about your own perspective. Do you see gold as something outdated, something that no longer fits into a modern investment strategy? Or are you starting to see why it continues to hold value, even in a world dominated by technology and digital assets? Drop your thoughts in the comments, because this conversation is bigger than just numbers. It's about how people understand and respond to uncertainty in different ways. And if this is starting to make sense to you, don't keep it to yourself. Share this with someone who's trying to figure out where things are headed, because most people are still looking in the wrong direction, focusing only on what's loud and obvious, while missing what's quiet and important. And right now, gold sits right in that quiet space, slowly building a story that could become impossible to ignore as 2026 continues to unfold. As we go deeper into this, there's one detail that changes everything. If you really understand it, gold is not competing with stocks or crypto in the way most people think. It plays a completely different role. It's not about growth. It's about preservation. And in times when markets feel uncertain or stretched, that role becomes incredibly important. Because while other assets depend on performance and confidence, gold depends on stability and trust. And when that trust starts to weaken, even slightly, gold doesn't need hype to move, it just needs time. Another layer that often goes unnoticed is how global demand is shaping this market. It's not just about the United States. Countries around the world are actively increasing their gold reserves, especially those looking to reduce dependence on the US dollar. And this creates a shift that goes beyond short-term price movements. It becomes part of a larger financial strategy, one that could redefine how value is stored and transferred over time. And when multiple nations move in the same direction quietly, it usually means they're responding to something deeper than what's being discussed publicly. At the same time, supply isn't expanding fast enough to match this growing demand. Mining production has its limits, new discoveries are rare, and the process of bringing new gold into the market takes years, not months. So when demand continues to rise while supply stays relatively tight, it creates a natural imbalance, and that imbalance doesn't always show immediate results. But over time, it builds pressure that can push prices in ways that seem sudden to those who weren't paying attention early. There's also a shift happening in how everyday investors access gold. It's no longer limited to physical bars or coins locked away in vaults. Today, there are multiple ways to gain exposure, from digital platforms to investment funds, making it easier than ever for people in the US to include gold in their portfolios. And this increased accessibility means that when sentiment changes, participation can increase much faster than it did in the past, amplifying the overall movement of the market. And here's where things become even more interesting, because gold's biggest strength is also what makes it easy to ignore. It doesn't promise excitement, it doesn't offer overnight success stories, but it has something far more powerful: consistency over time. And in a financial world that often feels unpredictable and fast-moving, that kind of consistency can become a major advantage for those who understand its role and position themselves accordingly before the rest of the crowd starts paying attention. But here's the part that most people don't fully see yet. Gold doesn't just react to economic data, it reacts to perception. And perception can shift faster than reality. One unexpected policy decision, one financial shock, or even a sudden loss of confidence in a major institution can change how investors think almost overnight. And when that shift happens, assets like gold don't wait for confirmation. They move ahead of the narrative, and that's why the early phase always feels quiet, almost uncertain, until it isn't. If you look closely at past cycles, there's a repeating pattern. Gold spends long periods being ignored, almost forgotten, and then slowly starts gaining strength while attention is still elsewhere. And by the time mainstream media begins covering it heavily, a large portion of the move has already happened. And this cycle is not based on coincidence, it's based on behavior, on how people react to risk, and more importantly, how late most people tend to react once something becomes obvious. Right now in 2026, we may be sitting somewhere in the middle of that cycle. Not at the very beginning, but definitely not at the end either, and that's what makes this moment so important. Because it's a phase where awareness can still make a difference, where understanding the signals can still position you ahead of the curve. And while nothing in markets is ever guaranteed, recognizing patterns like this gives you an edge that most people simply don't have. Think about how quickly narratives can change in today's world. One year it's all about growth and expansion. The next, it's about caution and protection. And these shifts don't happen randomly. They follow underlying conditions that build over time. And gold sits right at the intersection of those shifts, responding not just to what is happening, but to what people believe is about to happen next. And that forward-looking nature is what makes it such a powerful indicator. So as you continue watching this unfold, keep asking yourself one simple question: are you reacting to the market like everyone else, or are you starting to understand the deeper story that's shaping it? Because the difference between those two approaches often defines the outcome. And in a year like 2026, where uncertainty and opportunity exist side by side, the difference matters more than ever. And as this story continues to unfold, there's something even more subtle happening that most people overlook: the relationship between fear and timing. Because in financial markets, fear doesn't show up all at once. It builds slowly, almost invisibly, until it reaches a tipping point, and gold tends to respond during that build-up phase. Not after the panic has already started, which means by the time the average person feels the urgency, the groundwork has already been laid by those who were paying attention earlier. You can already see small signs of this shift in behavior: investors becoming slightly more cautious, conversations around risk becoming more frequent, and a growing awareness that the current system, while still functioning, is under pressure from multiple angles. And none of this guarantees a major disruption. But it does create the kind of environment where protective assets like gold begin to make more sense, not as a reaction, but as a preparation. Another important detail is how quickly sentiment can spread once it starts, especially in the United States, where financial news, social media, and market reactions move at incredible speed. Once gold enters mainstream conversation again, the shift won't be slow anymore. It will accelerate. And this is where many people get caught off guard because they mistake speed for opportunity. when in reality, the best opportunities usually existed before the acceleration even began. At this point, I want to bring you directly into the conversation again, because your perspective matters here. Do you think we are already seeing the early stages of a bigger move in gold? Or do you believe this is just another temporary phase that will fade away? Drop your thoughts in the comments and be honest about how you see it, because these discussions help build a clearer picture of what people are really thinking as this situation develops. And if this breakdown is helping you connect the dots in a way that feels clearer than the usual noise, make sure you share this with someone who's trying to understand where the economy might be heading next. Because right now, information alone isn't enough. It's about interpretation. It's about seeing patterns before they become obvious. And that's exactly what we focus on here at Metal Market Insight, helping you stay one step ahead in a world that's constantly changing. As we move closer to the final part of this story, there's one more layer that deserves your attention, and it's something that rarely gets discussed openly: the idea that gold is not just a financial asset, but a signal of shifting power in the global economy. Because when countries begin to rely less on traditional systems and more on physical reserves, it suggests a deeper transition, one that goes beyond short-term market movements and points toward long-term strategic positioning that could reshape how value is measured worldwide. In the United States, the shift may not feel immediate. Daily life continues, markets open and close, headlines come and go, but beneath that surface, structural changes are happening, debt levels remain high, policy decisions are becoming more complex, and global competition is intensifying. And while none of this guarantees a dramatic outcome, it does create a backdrop where assets like gold naturally gain relevance, not because they are new, but because they have always existed outside of these changing systems. At the same time, one of the biggest misconceptions about gold is that it only matters during crisis. But in reality, its role is established long before any crisis becomes visible. It acts as a form of quiet insurance, something that doesn't draw attention when things seem stable, but proves its value when conditions begin to shift unexpectedly. And understanding this timing is what separates those who prepare early from those who react too late. Now, as you reflect on everything we've discussed, from central bank behavior to market psychology, from supply and demand to global strategy, you start to see that gold's story in 2026 is not about a single factor. It's about the convergence of multiple forces all pointing in a similar direction. And when different signals begin to align like this, it usually means something meaningful is developing, even if it hasn't fully revealed itself yet. And this brings us to the final thought I want to leave you with. The market doesn't reward attention when it's comfortable. It rewards awareness when things are uncertain. And right now, gold sits right at the center of that uncertainty, quietly building its case while most people are still focused elsewhere. So the real question is not whether gold will move, but whether you'll recognize the significance of this moment before it becomes obvious to everyone else. As we reach the final part of this Sunday special story, there's a simple but powerful reality that ties everything together. Gold has never needed permission to matter. It doesn't depend on trends, it doesn't rely on hype cycles, and it doesn't wait for headlines to validate its importance. It moves based on deeper forces like trust, scarcity, and global behavior. And that is exactly why it continues to reappear in every major economic cycle, even when people think its time has passed. When you step back and look at 2026 from a wider lens, what you see is not a single clear direction, but a world balancing between stability and uncertainty, where growth and risk are happening at the same time. And in that kind of environment, markets don't behave in a straight line. They move in waves of confidence and caution, and gold tends to benefit when caution slowly starts becoming part of the global conversation again, even before it turns into full fear. This is where most people make their biggest mistake. They wait for confirmation, they wait for obvious signals, they wait for the moment when everything is already visible, but by then the early phase is over, and the opportunity has already been shaped by those who understood the pattern before it became clear, and gold, more than most assets, rewards that early awareness, because its strongest moves often begin in silence, not in spotlight. So as you think about everything shared in this breakdown, from central banks quietly accumulating, to shifting trust in financial systems, to the slow pressure building across global markets, the real takeaway is not a prediction. It's perspective, understanding that gold is not reacting to one event. It is responding to a collection of global signals that take time to fully appear, and that time is where informed decisions are made. And finally, as we close this Sunday special on the Truth About Gold 2026 market, remember this from Metal Market Insight: the goal is not to create fear or hype, but awareness. Because in every market cycle, the biggest advantage goes to those who notice the shift before it becomes obvious. So keep watching, keep questioning, and most importantly, keep thinking ahead. Because the next phase of this story is not just about gold, it's about how you position yourself before the world agrees on what already started happening quietly in the background.